These 13 car companies are about to disappear forever. The automotive industry is experiencing a wave of failures, bankruptcies, and strategic retreats that will permanently alter the landscape of brands available to consumers. While manufacturers and dealerships maintain optimistic public facades, behind closed doors there's genuine panic about which companies will survive the next 12 to 24 months. This isn't just industry speculation, it's already happening with formal bankruptcies, stock delistings, and desperate last-ditch strategies playing out in real time. What makes this situation particularly alarming for consumers is the potential financial disaster awaiting anyone who purchases vehicles from these endangered brands. When a car company disappears, it doesn't just mean the end of new models, it means collapsing resale values, parts availability nightmares, warranty support vanishing overnight, and dealer networks abandoning customers as they pivot to surviving brands. A $50,000 vehicle can quickly become worth less than $15,000 when its manufacturer ceases operations. If you're considering a vehicle purchase in 2026, understanding which manufacturers face existential threats isn't just interesting industry gossip, it's critical financial information that could save you from making a catastrophic investment in a brand that won't exist by the time your loan is paid off. Let's examine the 13 car companies standing at the precipice of permanent disappearance. You might assume that only obscure startups and financially troubled legacy brands face extinction in today's automotive marketplace. That's true for some companies on this list, but what's genuinely shocking is how many seemingly established luxury and performance brands are fighting for survival despite their prestige and storied histories. What's particularly surprising is the pattern of vulnerability that emerges across different types of automotive companies. Several brands that recently attracted billions in investment and media attention are now teetering on the edge of collapse. Multiple European luxury marques with decades of heritage face extinction or radical transformation, and several American household names may soon exist only as nostalgic memories rather than as vehicles you can actually purchase. Perhaps most revealing is what this wave of potential failures tells us about the brutal economics of today's automotive industry. The companies at risk share common fatal flaws that provide crucial lessons for consumers about which manufacturers represent safe harbors for your transportation dollars in these turbulent times. Which specific car companies face imminent extinction in today's rapidly evolving automotive landscape? What factors have pushed these manufacturers to the brink of disappearance? And most importantly, what does this unprecedented wave of potential failures mean for consumers considering vehicles from these endangered brands? Let's examine the 13 car companies that industry insiders believe are about to disappear forever. Group 1. The already dead liquidation phase. Some automotive brands have already moved beyond the danger zone into formal bankruptcy proceedings or liquidation. These companies aren't just at risk, they're actively in the process of disappearing from the marketplace, creating immediate consequences for existing owners and significant warnings for potential buyers. 1. Canoo. In January 2026, Canoo officially filed for Chapter 7 bankruptcy, marking the formal end of a once promising electric vehicle startup. This wasn't a Chapter 11 reorganization with hopes of emerging stronger. This was a complete liquidation that signals the permanent disappearance of the brand and its distinctive lifestyle vehicle. The company's trajectory followed a sadly familiar pattern for automotive startups. Initial hype and promising prototypes followed by production delays, cash flow problems, and increasingly desperate attempts to secure additional funding. Despite briefly appearing to gain momentum through a partnership with Walmart for delivery vehicles, the company ultimately couldn't overcome its financial challenges and manufacturing hurdles. For consumers, the implications are severe and immediate. Any Canoo vehicles that managed to reach customers before the bankruptcy filing are now effectively orphaned products. Automobiles without a parent company to provide warranty support, software updates, or replacement parts. Dealer service departments have no factory to call for technical assistance, and as components fail, owners will face increasingly creative workarounds or expensive third-party solutions. Perhaps most financially devastating for owners, resale values have collapsed almost overnight. With the company's liquidation, these vehicles have transformed from innovative transportation solutions to cautionary tales with little practical value beyond serving as conversation pieces, or as one industry analyst bluntly described them, expensive lawn ornaments. The verdict for potential buyers encountering any remaining new or used Canoo vehicles is unambiguous. Don't touch them at any price. These are no longer viable transportation options, but collector items for those willing to accept their status as non-serviceable novelties rather than practical vehicles. 2. Fisker. While Canoo's demise is just beginning, Fisker's collapse has already run its course, providing a fully realized example of what happens when an automotive manufacturer completely disappears. The liquidation is complete, with remaining assets sold off to pay creditors and the company existing now only as a cautionary business school case study. The Fisker Ocean SUV, once touted as a legitimate competitor to established electric vehicles with its distinctive design and sustainability focus, has become the poster child for resale value collapse when a manufacturer fails. Vehicles that originally commanded price tags around $70,000 are now selling for as little as $15,000 at auction, a catastrophic 80% value erosion that has left owners financially devastated. The situation for current Fisker owners goes beyond mere financial loss to practical usability challenges. With company servers shut down and support infrastructure non-existent, owners have been forced to form online communities focused on developing homebrew software solutions and hacks just to maintain basic functionality in their vehicles. Functions that relied on cloud connectivity or manufacturer support have simply ceased to work, transforming once premium vehicles into partially functional transportation hampered by erratic software behavior. Fisker's complete collapse serves as what one industry analyst described as the ghost of Christmas future for the other endangered brands on this list, a fully realized example of what awaits both companies and their customers when an automotive manufacturer ceases to exist. The company's rapid transition from promising luxury EV maker to complete liquidation provides a sobering timeline for how quickly similar situations could unfold for other vulnerable manufacturers. Group 2. The Stellantis Chopping Block. Stellantis CEO Carlos Tavares has made no secret of his willingness to eliminate underperforming brands, publicly stating that each of the company's 14 marques has a limited time to prove profitability or face extinction. Within this portfolio, 3 brands stand out as particularly vulnerable based on sales performance, market positioning challenges, and internal resource competition. 3. Chrysler. Once a pillar of American automotive manufacturing, Chrysler has been reduced to what industry insiders describe as a zombie brand. Technically alive but lacking the product portfolio, distinct identity, or market relevance to justify its continued existence as a standalone mark within the Stellantis empire. The fundamental problem is brutally simple. Chrysler currently sells just one vehicle, the Pacifica minivan. With the discontinuation of the 300 sedan, the brand has been reduced to a single product in a shrinking vehicle category. This extreme portfolio limitation violates the basic economics of modern automotive manufacturing, where development costs, marketing expenses, and dealer network maintenance require distribution across multiple vehicle lines to achieve profitability. Internal Stellantis documents leaked to industry publications reveal ongoing discussions about absorbing the Chrysler nameplate into either Dodge or Jeep by 2027, effectively ending its existence as a separate brand while potentially retaining the name for specific models within another marque's lineup. This approach would allow Stellantis to maintain any remaining brand equity while eliminating the overhead of supporting a distinct manufacturer identity. For consumers considering a Chrysler purchase, this precarious position raises significant questions about future support, parts availability, and resale value retention. While Stellantis would likely maintain parts production and warranty support through a transition period, the precedent from other discontinued brands suggests a gradual erosion of service quality and parts availability as the parent company reallocates resources to surviving marques. 4. Maserati. Despite its storied Italian heritage and luxury positioning, Maserati finds itself in an increasingly desperate situation within the Stellantis portfolio. Multiple industry sources confirm that Stellantis is actively exploring options to divest the brand, potentially selling it to either a luxury group looking to expand its portfolio or returning it to Ferrari, which previously owned the marque before the corporate restructuring that created Stellantis. The financial realities driving this potential sale are stark. Maserati is reportedly losing money on every vehicle it sells, with production costs exceeding revenue even on its highest margin models. The recently launched Grecale SUV, intended to boost volume and profitability by competing in the lucrative luxury crossover segment, has fallen dramatically short of sales targets, further straining the brand's already precarious finances. Industry analysts note that Chinese luxury conglomerates have expressed interest in acquiring European luxury brands, raising the possibility that Maserati could follow Volvo and Lotus into Chinese ownership. While this outcome might ensure the brand's survival in some form, it would likely trigger significant changes in manufacturing locations, component sourcing, and design philosophy, potentially undermining the Italian identity that forms the core of Maserati's appeal. For potential Maserati customers, this uncertainty creates substantial risks. If the brand is sold to a new owner with limited automotive experience or different quality standards, both the ownership experience and resale values could deteriorate rapidly. Current models might quickly become orphan designs as a new parent company pivots to its own platforms and technology, creating parts availability challenges and accelerating depreciation. 5. Alfa Romeo, North America. While Alfa Romeo may continue as a viable brand in European markets, its North American operations face a genuine existential threat due to persistently disappointing sales performance and high operational costs. Industry insiders with knowledge of Stellantis planning discussions indicate that a complete withdrawal from the U.S. market is under active consideration for 2026. The fundamental challenge is succinctly summarized by one dealer group executive: Americans just don't buy Alfas. Despite critically acclaimed driving dynamics and distinctive Italian design, the brand has failed to gain traction with American luxury buyers who continue to favor German and Japanese alternatives. The Tonale compact SUV, positioned as the volume model that would finally establish the brand in the crucial American crossover market, has been overshadowed by its corporate cousin, the Dodge Hornet, a vehicle that shares its platform but sells at a lower price point and through a more established dealer network. Stellantis financial disclosures reveal that maintaining Alfa Romeo's separate U.S. import operations, dealer network, and marketing presence requires sales volumes substantially higher than the brand has been able to achieve. Each vehicle sold must cover a disproportionate share of these fixed costs, forcing pricing strategies that make the vehicles less competitive in their segments and creating a downward spiral of declining sales and increasing per-unit overhead. For consumers considering an Alfa Romeo purchase in North America, the potential market exit represents a significant risk. If the brand withdraws from the U.S., owners would face immediate challenges with warranty service, parts availability, and technical support. While Stellantis would likely maintain some level of parts supply through existing dealer channels, the precedent from other market exits suggests a gradually deteriorating ownership experience as trained technicians become scarcer and component lead times extend from weeks to months. Group 3. The delisting danger zone. Several automotive companies face a critical financial threat beyond just poor sales or profitability challenges: the risk of being delisted from stock exchanges due to sustained low share prices. This situation creates a potentially fatal financing trap where companies simultaneously need capital to survive but can't easily access public markets due to their precarious trading status. 6. Polestar. Polestar's situation represents one of the most dramatic reversals among recent automotive startups. The company, originally positioned as Volvo's premium electric performance brand, with the financial stability and manufacturing expertise of established automotive players behind it, now faces a NASDAQ delisting warning as its share price has fallen below the critical $1 threshold. The company's challenges accelerated significantly when Volvo recently reduced its ownership stake, effectively pushing Polestar to operate more independently just as it faces its most serious financial challenges. This strategic retreat by Volvo signals diminished confidence in Polestar's business model and future prospects, removing what had been perceived as an important safety net for the developing brand. Industry analysts note that Polestar's fundamental product strategy, creating design-focused, performance-oriented electric vehicles, has actually produced compelling automobiles that receive generally positive reviews. However, the business model surrounding these products has failed to achieve sustainable economics, with production costs, marketing expenses, and dealer network development outpacing revenue growth. If delisting occurs, Polestar would face severely restricted access to capital markets just when it needs financing most to fund ongoing operations and next-generation product development. This financial constraint could force dramatic action, with many industry observers predicting the brand might ultimately be reabsorbed into Geely, the parent company of both Volvo and Polestar, and reduced to a trim level or sub-brand rather than continuing as an independent manufacturer. For consumers considering a Polestar purchase, this financial uncertainty creates significant risks regarding future support, warranty service, and resale value. While the vehicles themselves are generally well-engineered, owning a product from a manufacturer undergoing financial restructuring or potential absorption by its parent company typically leads to compromised support and accelerated depreciation. 7. Faraday Future. Faraday Future has become what one industry analyst described as a corporate zombie, a company that continues to exist despite fundamentals that would typically drive a business to formal bankruptcy. The company has sold fewer vehicles than most people have fingers, yet continues to operate through a series of increasingly desperate financial maneuvers and strategic pivots. The company's pattern of behavior has become predictable to industry observers. When financial reality threatens immediate collapse, management announces a new strategic direction, partnership possibility, or market opportunity that provides just enough narrative change to secure bridge financing or maintain share price above total collapse. These announcements rarely translate into meaningful operational progress, creating a cycle of perpetually deferred expectations. Financial filings reveal a company consuming capital at an unsustainable rate while generating minimal revenue from actual vehicle sales. Each produced unit reportedly costs far more to manufacture than its selling price, creating a fundamental economic reality where increased sales would actually accelerate financial losses rather than moving toward profitability. For potential customers, the risk of purchasing a Faraday Future vehicle extend beyond typical concerns about a new manufacturer to questions about whether service infrastructure, parts supply, or warranty support will exist even months into ownership. With the company perpetually on the brink of financial collapse, any vehicle purchase represents a speculative investment in the company's survival rather than a practical transportation decision. 8. Mullen Automotive. Mullen Automotive exemplifies a particularly troubling category of automotive company, one where the primary business activity appears to be maintaining stock market presence rather than developing viable transportation products. The company has executed multiple reverse stock splits specifically designed to maintain listing requirements rather than reflecting any fundamental business improvement. Industry analysis of the company's public statements, production claims, and financial disclosures reveals a pattern that prioritizes maintaining access to capital markets over developing manufacturing capability or customer-ready products. As one automotive financial analyst bluntly assessed, "This is not a car company, it's a stock promotion machine." The company's history of acquisitions, announced partnerships, and strategic pivots follows a pattern of generating press releases and temporary share price movements without building substantial manufacturing infrastructure or delivering significant numbers of vehicles to paying customers. Each announcement typically precedes capital-raising activities, creating a cycle that has sustained the company's existence without demonstrating progress towards sustainable operations. For consumers, the verdict is clear and unambiguous. Avoid any involvement with Mullen vehicles at all costs, regardless of advertised specifications or price points. The fundamental business reality suggests these products represent speculative concepts rather than viable transportation solutions backed by a sustainable manufacturing operation and support infrastructure. 9. Nikola. Nikola's transition from controversial electric and hydrogen truck startup to serious bankruptcy risk illustrates how quickly fortunes can change in the alternative powertrain commercial vehicle space. After pivoting from its troubled founder's vision to focus more narrowly on hydrogen-powered commercial trucks, the company has encountered the fundamental chicken and egg problem facing hydrogen transportation. Vehicles need infrastructure to succeed, but infrastructure requires vehicles to justify investment. Financial disclosures reveal an unsustainable cash burn rate as the company attempts to simultaneously develop vehicles, convince commercial customers to adopt them, and support the creation of hydrogen fueling infrastructure. This three-front battle requires capital resources beyond what the company can currently access, creating a countdown to potential insolvency without dramatic changes in market conditions or external investment. Industry analysts tracking the commercial transportation sector note that Nikola faces the additional challenge of competing with established truck manufacturers who are developing their own alternative powertrain solutions with the advantage of existing customer relationships, service networks, and manufacturing economies of scale. This competitive disadvantage further complicates Nikola's already challenging path to sustainability. While Nikola's situation primarily affects commercial transportation rather than consumer vehicles, the company's potential failure represents a significant data point in understanding the broader challenges facing alternative powertrain startups. The lesson for all automotive consumers is that pioneering technology without sufficient capital and infrastructure support creates extraordinary business risks that ultimately translate to ownership risks. Group 4. The billion-dollar gambles. The final category of endangered automotive companies represents established brands making radical, high-risk strategic pivots that could either reinvent their businesses for long-term success or accelerate their demise. These billion-dollar gambles represent all-or-nothing bets on particular visions of the automotive future, with a little middle ground between triumph and disappearance. 10. Jaguar. Jaguar's current situation represents perhaps the most dramatic and risky reinvention attempt in recent automotive history. The storied British luxury brand has made the unprecedented decision to completely cease production of its entire current vehicle lineup, terminate relationships with many existing dealers, and reposition itself as an ultra-luxury EV brand targeting Bentley-level pricing and exclusivity. This strategy has created what industry insiders describe as a self-imposed extinction event, an intentional business disruption so severe that it either succeeds completely or ends the brand's existence. By halting production of current models before their replacements are ready, Jaguar has created a revenue gap that can only be bridged through the financial resources of its parent company, Tata Motors, which must sustain the brand through this transition period. The first product of this reinvention, the upcoming 2026 GT, represents a make-or-break moment for the brand's continued existence. If this vehicle fails to immediately capture the ultra-luxury market Jaguar is targeting, industry analysts believe Tata would likely shutter the passenger car brand entirely and fold any remaining valuable operations into the more successful Land Rover division. For consumers, this transition creates both immediate practical concerns and longer-term questions about the brand's viability. Current Jaguar owners already face challenges with parts availability and service as the company redirects resources toward its new strategy. Potential customers for the upcoming GT must evaluate whether they're willing to be early adopters of what amounts to an entirely new automotive brand using the Jaguar name rather than a continuation of the manufacturer's historical identity. 11. VinFast. VinFast represents a uniquely structured automotive risk case. A company with virtually unlimited short-term financial resources, but fundamental product and strategy challenges that create serious questions about long-term viability. As a division of Vingroup, Vietnam's largest conglomerate, VinFast benefits from the personal wealth and commitment of founder Pham Nhat Vuong, who has demonstrated willingness to absorb substantial losses to establish the brand. The company's fundamental challenge is that it has attempted to expand globally at an unprecedented pace, while its vehicles have received consistently negative reviews regarding quality, technology integration, and value proposition. This combination of rapid expansion and product criticism creates a particularly dangerous business situation where fixed costs grow while consumer demand fails to materialize as projected. financial analysis of VinFast's operations suggests the company is currently sustained almost entirely by its chairman's willingness to cover losses rather than by a viable business model approaching sustainability. This dependency creates an unusual risk factor for potential customers. If Vuong's commitment to the project wavers, or if Vingroup's other business interests require capital reallocation, the company could face abrupt financial crisis despite its apparent resources. The visible evidence of VinFast's challenges can be found on dealer lots across its markets, where unsold VF8 models accumulate in numbers that suggest fundamental rejection by consumers. This inventory buildup creates financial pressure that will eventually force either dramatic strategy changes or market withdrawal, regardless of the founder's personal commitment to the project. For consumers, the risk assessment is straightforward. Purchasing a VinFast vehicle means betting not just on a new automotive brand, but on the continued willingness of a single businessman to absorb losses that industry analysts estimate at hundreds of millions of dollars annually, with no clear path to profitability in sight. 12. Lucid Motors. Lucid Motors presents a fascinating case study in the disconnect between engineering excellence and business sustainability. The company has unquestionably delivered on its technical promises, producing electric vehicles with industry-leading range, performance, and charging capabilities. The Lucid Air, particularly in its Sapphire configuration, represents genuine innovation that has advanced the state-of-the-art in electric vehicle design. However, this technical achievement exists alongside a business reality that remains deeply challenging. The company reportedly loses hundreds of thousands of dollars on every vehicle it sells, with manufacturing costs far exceeding even the premium prices its models command. This fundamental economic disconnect creates a business that depends entirely on continued investor support rather than operational sustainability. Lucid's unique risk factor stems from its ownership structure, with Saudi Arabia's Public Investment Fund, PIF, controlling a majority stake. This backing provides short-term financial security but creates a different type of risk for consumers: the possibility of privatization. Industry analysts note that if the public market valuation of Lucid continues to decline, the PIF might find it more advantageous to take the company private, potentially complicating service, parts, and warranty support for existing owners. For potential Lucid customers, this situation creates a complex risk assessment. The vehicles themselves represent genuinely impressive engineering achievements that may justify their premium pricing on technical merits. However, the uncertain future of the company's ownership structure and business model creates legitimate concerns about long-term support and resale value that must factor into purchase decisions. 13. Lotus. Lotus, one of the most storied names in performance automobiles, finds itself at a pivotal moment in its long history. Under Geely ownership, the brand has attempted to transform from a niche sports car manufacturer into a broader luxury performance brand with the Eletre SUV as its volume-driving flagship. This transformation represents a fundamental identity shift that carries substantial business risk despite the financial backing of its Chinese parent company. The early results of this strategy raise significant concerns about its viability. The Eletre, positioned as Lotus's answer to the Lamborghini Urus and Porsche Cayenne, has failed to achieve the sales volumes necessary to support the brand's expanded operations and development costs. This performance shortfall creates pressure to either revise the strategy or reconsider the brand's position within the broader Geely portfolio. Industry analysts familiar with Geely's operations note that the company has demonstrated pragmatism in managing its brand portfolio, suggesting that if Lotus cannot achieve sustainable economics as a volume manufacturer, Geely might pivot to utilizing Lotus primarily as an engineering consultancy while drastically reducing or eliminating its consumer vehicle operations. This outcome would effectively end Lotus as a mainstream automotive manufacturer while potentially preserving the name for special projects or technology development. For consumers considering Lotus products, this strategic uncertainty creates significant questions about future support and resale value. While Geely's overall financial stability provides some reassurance about parts availability and warranty coverage, the potential transformation or scaling back of Lotus as a consumer brand would likely impact dealer networks, service availability, and ultimately the ownership experience. The potential disappearance of these 13 car companies represents far more than just an interesting industry development. It creates immediate and significant financial risk for consumers who own or are considering purchasing vehicles from these endangered brands. The stakes of these corporate failures escalate dramatically when viewed through the lens of consumer impact. When an automotive manufacturer ceases operations, the consequences for owners unfold in predictable and financially painful stages. Initially, warranty support becomes compromised as dedicated systems, technical experts, and part supplies become increasingly difficult to maintain. Dealer service departments find themselves unable to properly diagnose or repair vehicles without manufacturer support, leading to improvised solutions of varying quality and reliability. Parts availability follows a similar deterioration curve, with common wear items becoming increasingly difficult to source and major components eventually becoming unavailable at any price. This parts crisis transforms otherwise repairable vehicles into effectively totaled assets when key components fail without replacement options, forcing owners to either abandon their vehicles or pay exorbitant prices for salvaged parts from other vehicles. Perhaps most financially devastating is the collapse in resale values that accompanies manufacturer failure. The Fisker example provides a sobering data point, with vehicles losing up to 80% of their value in a matter of months following the company's liquidation. This value collapse often happens faster than the physical deterioration of the vehicle itself, creating a situation where owners have functional transportation that has become nearly worthless as a financial asset. For consumers currently shopping for vehicles, understanding these risks is essential to making informed financial decisions. A purchase price that seems attractive can quickly become catastrophically expensive when factoring in accelerated depreciation, compromised usability, and potential early replacement necessity if a manufacturer fails. The true cost of ownership extends far beyond the purchase price and traditional operating expenses when buying from an at-risk brand. Here's what makes this wave of potential automotive failures particularly revealing. It exposes fundamental truths about the industry that manufacturers and dealers work hard to obscure from consumers. These aren't random business failures distributed evenly across the automotive landscape. They follow distinct patterns that highlight specific business models and strategies that have proven unsustainable in today's market. The twist is that many of these endangered companies represent precisely the categories that have received the most media attention, investor funding, and consumer interest in recent years. Electric vehicle startups with innovative designs but unsustainable manufacturing economics. Legacy luxury brands attempting radical reinventions without clear customer demand. Conglomerate-owned marques that no longer justify their position in corporate portfolios. What's particularly telling is the common factor across nearly all these at-risk companies. They're losing money on every vehicle they sell. While this reality is obscured by corporate financial structures, investor subsidies, or conglomerate support, the fundamental truth remains that sustainable automotive manufacturing requires profit per unit sold, a basic business reality that many of these companies have been unable to achieve despite years of operation and billions in investment. This pattern reveals an uncomfortable truth about today's automotive market. The gap between successful and unsuccessful manufacturers has never been wider. While certain companies generate thousands in profit per vehicle sold, others lose comparable amounts on each unit, creating an unsustainable economic reality that eventually forces either dramatic strategic changes or business failure regardless of how innovative or appealing their products might be. For consumers, this realization provides a crucial framework for evaluating automotive purchases beyond traditional considerations like features, performance, and initial price. The long-term viability of the manufacturer represents a critical factor in total cost of ownership, practical usability, and financial risk that must be considered alongside more conventional purchase criteria. The automotive industry is experiencing a wave of failures, bankruptcies, and strategic retreats that will permanently alter the landscape of brands available to consumers. From companies already in liquidation like Canoo and Fisker, to Stellantis brands facing the chopping block, to publicly traded companies facing delisting threats, to established names making billion-dollar strategic gambles, these 13 manufacturers face existential threats that create significant risk for current owners and potential buyers. When a car company disappears, the consequences for owners are severe and financially painful. Collapsing resale values, parts availability nightmares, compromised warranty support, and dealer networks that pivot away from orphaned brands. A vehicle purchase that seems attractive based on features and initial price can quickly become a financial disaster if the manufacturer ceases operations during your ownership period. Understanding which car companies face imminent extinction isn't just interesting industry gossip. It's critical financial information that could save you from making a catastrophic investment in a brand that won't exist by the time your loan is paid off. As we've seen with completed failures like Fisker, the financial consequences for owners can be swift and severe, with vehicles losing up to 80% of their value while simultaneously becoming increasingly difficult to maintain and repair. Conclusion: the safe harbor. Given these substantial risks, where should pragmatic consumers turn for automotive purchases in today's uncertain market? The answer lies in a fundamental principle that cuts through marketing hype and media fascination with automotive novelty. In 2026, stick to companies that actually make a profit. The most reliable predictor of manufacturer longevity isn't technology leadership, design innovation, or media attention. It's the basic business reality of profitable operations. Companies that generate positive earnings on each vehicle sold create financial sustainability that translates directly to consumer benefits. Ongoing product development, robust parts supply chains, dealer network stability, and warranty support backed by genuine financial resources. This profit focus naturally directs consumers toward established manufacturers with proven business models rather than startups promising revolutionary approaches or legacy brands attempting desperate reinventions. Toyota, Honda, Hyundai/Kia, BMW, and other consistently profitable manufacturers may seem less exciting than emerging alternatives, but they represent significantly lower ownership risks, precisely because their business fundamentals support long-term market presence. For consumers drawn to electric vehicles, this principle suggests favoring established manufacturers who have integrated EVs into profitable overall operations rather than pure EV startups struggling with manufacturing economics. Companies like Tesla, which has achieved consistent profitability, or traditional manufacturers with growing electric offerings provide the innovation benefits of electrification without the existential business risks of financially precarious startups. The fundamental truth underlying this safe harbor approach is that automotive manufacturing remains an extraordinarily capital-intensive, low-margin business requiring massive scale and operational discipline to achieve sustainable economics. The romantic notion of disruptive newcomers revolutionizing the industry often collides with these harsh business realities, creating the pattern of failures and endangered companies we've examined. In an era of automotive uncertainty and transition, the wisest consumer approach combines enthusiasm for innovation with clear-eyed assessment of business fundamentals. Love underdog stories and revolutionary approaches if you must, but when you're spending $50,000 on a vehicle expected to provide years of service, bet on profitable operations rather than promising concepts or desperate reinventions.